Okay, get ready for an absolute game changer. Imagine dropping $100,000 into crypto ETFs. What happened next? The undeniable truth about Bitcoin, XRP, and Solana in 2025 is a story you won't want to miss. Seriously. Today, we're taking a deep dive into this really insightful report, an institutional-grade analysis for U.S. investors, all focused on crypto ETFs. But look, before we jump in, a crucial note. This whole deep dive, it's for educational purposes only. Okay, it is not financial advice.
Absolutely not.
Crypto investments carry substantial risk. I mean, extreme volatility, regulatory uncertainty, and yeah, you could lose your entire capital. Always, always consult with a registered financial advisor before making any investment decisions. And remember, past performance doesn't guarantee future results.
Right.
This research was compiled by ChannelVest using advanced AI analysis tools and institutional data. You're with ChannelVest. This is your analysis.
Yeah, and it's so important to absorb those disclaimers because this crypto space is just evolving incredibly fast. Being truly informed, well, it starts with understanding the landscape, and that includes all the risks.
Totally. So we're about to unpack the shocking truth about XRP, Solana, and Bitcoin in 2025, and it kicks off with a revolution nobody really saw coming. Stick around. The $162 billion revolution nobody saw coming. I mean, this is a remarkable. In just 18 months, crypto ETFs went from these sort of experimental things into a $162 billion institutional-grade asset class. You heard that right. $162 billion total AUM.
Wow. And what really stands out here isn't just the sheer size, right? It's the growth rate. A staggering 91% AUM growth over the past 12 months. And get this, the Sharpe ratio is 1.67 for these ETFs.
1.67 compared to what?
Well, compared to 0.95 for the S&P 500. So for anyone listening, a higher Sharpe rate ratio basically means you're getting more return for the risk you take. This profile is really compelling from a risk-adjusted perspective. It kind of makes you wonder, why did this massive shift catch so many people off guard?
Exactly. And you know what? That explosion is just the start. You might be completely blown away by what's really going on behind the scenes. What's really happening behind the scenes? The scale of institutional demand here is, well, it's huge. BlackRock's IBIT, just that one fund, has piled up an incredible $84.8 billion in assets. That's a massive signal from a major player, isn't it?
It really is.
Yeah.
And looking at the bigger picture, it's not just BlackRock, right? It shows this unprecedented institutional appetite, this hunger for the asset class. And at the same time, we're right on the edge of more expansion.
Like what?
Like XRP and Solana ETFs getting closer to regulatory approval. Our data suggests this could expand the market by maybe another $7 to $14 billion within the next 12 to 18 months. It's just a clear sign of ongoing, really strong growth.
But wait, there's an even bigger reason Wall Street is going all in on these crypto ETFs, and it's something I think many investors are completely missing. The real reason Wall Street is going all in. And it points to this massive opportunity that, maybe retail investors aren't seeing: superior returns. We're talking an average return of 78.8% for Bitcoin ETFs.
70.8%.
Yeah, compared to just 24.6% for the S&P 500. That difference is just huge.
It is. And beyond just those headline returns, there's this really critical element of regulatory clarity emerging, especially with SEC Chair Paul Atkins stating that most cryptocurrencies don't qualify as securities. That's a big deal.
A game changer, really.
Exactly. And that's paved the way for substantial corporate adoption. We're seeing 160 corporations now holding over $103 billion in Bitcoin combined. Which, begs the question, how much more room is there for this corporate money to flow in?
And the projections are pretty wild. Institutional demand could push corporate treasury allocation to $330 billion by 2029. $330 billion. That's insane potential.
Okay, pause for a sec. If you're finding these insights valuable, seriously hit that subscribe button right now. You won't want to miss what's coming next. The Paul Atkins effect, regulatory game changer and corporate treasury revolution. That appointment of Paul Atkins as SEC chair in April 2025, it really did shift the whole regulatory picture, didn't it?
Oh, absolutely. We're talking safe harbor provisions, clear custody rules, new trading frameworks, simpler disclosures, the whole package.
Yeah.
And this combination, well, it's truly fueled this corporate treasury revolution we're seeing.
Where you can see the direct impact.
You really can. Like you said, about 160 corporations holding over $103 billion in Bitcoin. MicroStrategy alone is just incredible. 601,550 BTC, worth around $73 billion. And Bernstein analysts, they're projecting corporates will add another $330 billion in Bitcoin by 2029. This feels less like a trend and more like a fundamental structural shift, Definitely. The performance numbers that will shock you. Bitcoin ETFs have just delivered exceptional risk-adjusted returns across pretty much all major timeframes. These comparisons are going to blow your mind.
Yeah, looking at the one-year numbers again, Bitcoin ETFs averaged that 78.8% return with a 1.67 Sharpe ratio. Now compare that. S&P 500, 24.6% return, 0.95 Sharpe. NASDAQ, 28.9% return, 1.12 Sharpe. Gold, just 12.3% with a 0.62 Sharpe. It just clearly highlights how much Bitcoin ETFs have outperformed, especially considering the risk involved.
Incredible outperformance. But okay, with all this growth, you get fierce competition, right? The ETF fee war you need to know about. This is where things get intense, and it really matters for your bottom line.
We're definitely seeing some super competitive fees. You got BITB leading the pack at just 0.20%,
Yeah.
ARKB close behind at 0.21%, and IBIT FBTC at 0.25%. But then, yeah, GBTC really stands out with that much higher fee of 1.50%.
1.5%. That's a huge difference.
It really is. And it creates this sort of split market, right? You have the established players like GBTC who can kind of maintain that premium price because they were first. But the new guys, they're aggressively slashing costs to grab market share. It's intense.
Absolutely. Okay, another quick break here. If you're finding these insights like incredibly valuable and you appreciate us digging into these numbers, make sure you've hit subscribe and turned on those notifications. Seriously, you don't want to miss our next deep dive. So the growth, the performance, it's all compelling. But we got to look at the other side too. The hidden risks nobody's talking about. It's not all sunshine and rainbows, folks. You've got concentration risk, regulatory uncertainty, tech risk, market structure risks. They're all lurking. You absolutely need to understand this stuff.
Yeah, these risks are crucial to get your head around. Single asset concentration, for example, a Bitcoin-only ETF, means, well, you're not diversified within that specific investment. And despite improvements, the regulatory landscape, it's still evolving. That's a risk.
And the tech itself?
Right. Technology risks like, say, blockchain forks or big protocol upgrades, those can impact the underlying asset. And of course, periods of just extreme volatility can genuinely mess with normal market function. So it really raises that important question for any investor. How do you best manage this? How do you protect yourself?
That is the key question. But here's the interesting part, how the smart money, the institutions, are tackling these exact risks. Stay with us on this. Institutional-grade custody solutions. Now, to protect assets from those risks we just mentioned, the leading crypto ETFs use these incredibly robust, multi-layered custody setups. It's serious security.
What's really important here is that layered approach. You've got primary custodians, big names like Coinbase Custody, then secondary ones like BitGo, and they even integrate traditional banking infrastructure, like from Bank of New York Mellon.
So multiple layers of safety.
Exactly. These setups provide protections similar to FDIC insurance. It's important to stress they aren't actually FDIC-insured bank deposits, but they offer analogous security features. Plus, things like multi-signature security protocols and keeping client assets totally separate. These features directly tackle those big operational risk concerns that institutions have.
Okay, let's flip to shocking correlation truth. This could seriously change how you think about crypto ETFs. They show these high positive correlations with stock indexes, like between 0.70 and 0.73.
Wow, that high.
Yeah. And interestingly, negative correlations with the US dollar around N of 0.45. This has some major implications.
Okay, so what that data tells us is pretty clear. Crypto ETFs behave like risk-on assets, very similar to growth stocks, which immediately brings up a critical question, right?
Which is,
If they tend to move up and down with stocks, are they really diversifying your portfolio like, say, bonds or gold might? And based on this data, the answer is generally no. Crypto ETFs are usually not the diversification tool many people think they are. It's so vital to understand how they behave within the broader system before you allocate.
good point, the extreme risk numbers. These figures are going to put crypto ETF volatility into some serious perspective compared to traditional stuff. We're talking potential daily losses of 8.2% at a 95% value at risk.
8.2% daily.
Or even 12.3% in more extreme scenarios.
Wow. And just to give that some context, the S&P 500 usually has a one-day value at risk at that same 95% level of just 1.5%. So VAR, value at risk, it represents your maximum expected loss over a set time at a certain confidence level.
So the difference is huge.
Massive. Bitcoin ETFs clearly face way higher potential daily losses. The expected shortfall, which is like the average loss when things get really bad. The worst 1% of outcomes averages 15.8%. It just hammers home the elevated risk profile you're taking on with these assets.
Definitely something to keep in mind. And yeah, one player is just absolutely dominating the field, really setting the pace.
No surprise here, it's BlackRock's IBIT. It clearly stands as the dominant force. It commands that huge $84.8 billion in AUM we mentioned and holds a remarkable 62.75% share of the volume for spot Bitcoin ETFs. Its sheer size and activity, I mean, it's truly setting the benchmark.
King of the hill right now. So Wall Street is making a massive crypto bet. These numbers are the proof. You might actually be surprised which big names are quietly building up their positions.
Yeah, look at JP Morgan. They've got bullish projections forecasting Bitcoin to outperform gold in the second half of 2025.
Yeah.
Goldman Sachs, they significantly upped their crypto ETF exposure to $418 million in Q2 2024 with $238 million just in IBIT.
Wow, Goldman's in deep too.
And even Morgan Stanley holds $188 million in Bitcoin ETF exposure, again, mostly through IBIT. It just clearly shows this growing, widespread institutional belief, this conviction in the crypto space.
The big players are definitely here. So what's the next big crypto ETF opportunity? Get ready for XRP and Solana. This could be the next major wave.
Yeah, we're watching a few key things closely here. There are 8 XRP ETF applications facing SEC decisions between October 18th and 25th, 2025. Prediction markets, like Polymarket, they're suggesting an 81% approval probability. That could inject another, $48 billion in new assets?
Potentially huge. And Solana.
Solana ETF approval odds have hit an incredible 99% on those same prediction markets. You've got major applications from VanEck, Grayscale, Bitwise just waiting. And an interesting kicker for Solana ETFs could be the 7.3% staking yield component. That could actually boost the total returns for people holding the ETF.
Interesting angle with the staking. Okay, now here's something most people miss. The beta bomb most investors miss. Crypto ETFs show this unprecedented systematic risk average beta coefficients of 3.1 relative to the S&P 500. That's huge GE for your portfolio.
It really is. And it's insightful to understand what a beta of 3.1 actually means. Beta measures how much an asset moves compared to the overall market, right? So a beta of 3.1 means crypto ETFs tend to amplify stock market movements by about 300%.
3 times the move.
Pretty much, which positions them as these extreme growth allocations in a portfolio. It means their price swings, up or down, are likely to be significantly larger than the broader market swings. It's just a critical factor to consider when you're building your portfolio.
Absolutely critical. So given all that, what's the optimal allocation that maybe most advisors won't tell you? It's the sweet spot based on, get this, 10,000 portfolio simulations.
Yeah, this Monte Carlo analysis, which basically runs thousands of random scenarios, reveals that the optimal crypto allocation seems to sit right around 4% of your total portfolio weight.
Just 4%.
That specific allocation, according to this analysis, maximizes your risk-adjusted returns. It hits a 0.76 Sharpe ratio, providing about 10.1% expected returns, but with 13.3% volatility. For most investors looking to balance that growth potential with managing risk effectively, this really does seem to be the sweet spot.
4%. Got it. All right, time for the showdown. Bull versus bear case showdown. Which way will Bitcoin ETFs go in 2025? The potential upside here compared to the downside is, well, it's pretty compelling.
Yeah, the analysis lays out 3 distinct scenarios. First, there's a 25% chance of a bull case. Bitcoin hits $185,000. That would mean like 142% ETF returns, driven by things like Fed rate cuts and that huge projected $330 billion in corporate buying.
Okay, that's the dream scenario. What's more likely?
Well, the base case has a 50% probability Bitcoin reaches $135,000, giving you 78% adoption continues. And then there's the bear case, also a 25% chance. Bitcoin falls back to maybe $45,000, $65,000, maybe due to a recession or surprise rate hikes. That would mean 38% losses for the ETFs.
So still a chance of losses.
Absolutely. But what's clear from this analysis is that the potential upside, the magnitude of the potential gains and the bull and base cases, significantly outweighs the potential downside in the bear case. It's asymmetric.
Asymmetric upside. Got it. Now, want the perfect portfolio mix within your crypto allocation. Ideal way to split your crypto holdings.
Right, so this specific structure within that 4% allocation we talked about recommends putting 40% into IBIT, 35% into FBTC, and 25% into BITB.
Okay, why that mix?
Well, the strategy is to balance things out. You get IBIT's market leadership and massive liquidity. You get FBTC's strong performance. It actually boasts a slightly higher 1.69 Sharpe ratio in this data.
Yeah.
And then you add BITB for its cost leadership. Remember that super low 0.20% expense ratio. So the mix aims for efficiency and performance.
Makes sense. Diversifying within the diversifier? Sort of. Now, this is how the smart money rebalances. Forget just doing it every quarter. That's not enough for an asset this wild 43% annualized volatility. The triggers they use are next level.
You're absolutely right. Traditional quarterly rebalancing just doesn't cut it here. Smart money uses dynamic triggers. Like, they rebalance when 30-day crypto volatility spikes above 60% or drops below 25%. That's a volatility threshold trigger.
Okay, what else?
They also rebalance if their crypto allocation drifts more than 25% away from their target, that's called allocation drift, or if the correlation between crypto and stocks gets too high, like over 0.85 for 5 days straight, that's a correlation spike trigger. And there's even monthly rebalancing if the performance difference between their crypto ETFs gets too big, like over 300 basis points. That's performance divergence.
Wow, that's active management.
It really is. These sophisticated dynamic controls are pretty much essential for managing such a volatile asset class effectively. Yeah, this is a really key advantage. Crypto ETF structures offer significant tax benefits compared to just buying crypto directly, mostly because of how they handle redemptions, these in-kind redemptions. Basically, it often avoids triggering an immediate taxable event when assets move in and out of the fund.
Okay, so how can you, the listener, leverage this?
Well, there are strategies like cross-ETF harvesting. You could sell an ETF like GBTC to realize a loss for tax purposes, but immediately buy something like IBIT or FBTC to stay invested in Bitcoin, and crucially, avoid wash sale rules. You can also hold these ETFs in tax-deferred accounts, like an IRA, to completely eliminate taxes on short-term gains. Or for really large allocations, direct indexing might let you manage individual tax lots for even more control.
Some really valuable tax angles there. Okay, we're sharing the trading signals that actually work for crypto. This gives you a peek into the kind of precision pro traders use for timing their buys and sells.
All right, so for a primary entry point, this analysis suggests looking for Bitcoin around $95,000, combined with an RSI that's the relative strength index below 30, which suggests it's oversold. And you want volume confirmation, like 2 times the average daily volume.
Okay, that's primary entry. What about secondary?
Secondary entries might be around $85,000 for Bitcoin, maybe an RSI between 30 and 35, or spotting a clear double-bottom chart pattern. And for taking profits, targets mentioned include Bitcoin hitting $150,000, the RSI going above 75, oversold, or seeing a rising wedge pattern forming on the chart. This kind of multi-time frame technical analysis is really critical for more precise trading.
Lots of signals to watch. Now, let's zoom out. The macro signals that drive crypto. S&P Global's research found key economic indicators that tend to come before major crypto moves, and one stands out as the most reliable leading indicator you need to know.
Yeah, it's fascinating how these big-picture economic factors influence crypto. An expanding Fed balance sheet, think quantitative easing, it's usually bullish. Negative real yields, where inflation is higher than bond yields. Extremely bullish for crypto.
What about the dollar?
Dollar weakness, like the DXY index falling below 102, tends to help crypto prices. Strength above 108 is usually negative. A steepening yield curve is often bullish, signaling growth hopes, while an inverted curve is typically bearish for risk assets like crypto. And yes, the analysis identifies the Fed balance sheet as the single most reliable leading indicator for crypto performance. Watch the Fed.
Watch the Fed. Good advice. Okay. Protecting your capital is key. The risk management framework that protects your capital in this wild market. It's incredible how institutions use these multi-layered controls that, honestly, individual investors can learn a lot from.
Absolutely. Institutions use very strict position limits. A conservative approach might limit crypto to 2.5% of the total portfolio, balanced at 5%, maybe aggressive at 10%, but they also use daily VAR limits like we discussed.
And drawdown limits.
Yes, and drawdown triggers and correlation limits too. For example, a conservative daily VAR limit might be just 0.5% of the portfolio, and drawdown triggers could be set at 5%, meaning if the crypto holding drops 5%, they take action, maybe reduce the position. These layers of control are meticulously designed precisely to protect capital in such a volatile asset class.
Smart, layered defense. And finally, we bring it all together. The ultimate crypto ETF strategy. This is the comprehensive approach that aims to balance that huge growth potential with robust risk management, tailored for investors like you listening right now.
Right. This ultimate strategy pulls together several key elements we've discussed. It starts with that optimal allocation, 4% of your total portfolio weight, then specific ETF selection, 40% IBT, 35% FBTC, 25% BITB. It also emphasizes smart entry timing, suggesting dollar cost averaging your way in over maybe 3 to 6 months.
Don't just jump in all at once.
Exactly. And crucially, it includes active risk management, things like setting stop losses. Maybe if Bitcoin breaks below $75,000 with volume confirmation. Plus, regular monitoring, checking correlations weekly, reviewing performance monthly, and rebalancing quarterly based on those dynamic triggers we talked about. There's a whole robust approach, a structured way to navigate this market.
A full plan. Excellent. So what's the timeline for what happens next? the critical next 18 months. This period looks crucial for getting positioned early in this rapidly evolving space. You really won't want to miss these dates.
Okay, key dates to watch. We've got those XRP ETF approval decisions coming up between October 18th and 25th, 2025. Solana ETF final approvals are expected maybe late 2025. Then moving into Q1 2026, we could potentially see approvals for multi-coin crypto ETFs, maybe even integrating staking rewards directly into ETF structures.
Wow, multi-coin ETFs, that would be big.
It would. And further out, say 2026, 2027, we might start seeing more international coordination on regulations, harmonization initiatives. The whole landscape is just set for rapid, really significant change in the near term.
Absolutely rapid change ahead. So wrapping this all up, what does this all mean for you, the listener? Here's final thought to chew on. Will crypto ETFs fundamentally start replacing traditional holdings like gold and bonds in big institutional portfolios by, say, 2030? What do you think? Let us know in the comments. And hey, if you found this deep dive game-changing, please hit that like and subscribe button for more exclusive analysis just like this.